Welcome to our Friday webinar that will cover what happened this week in the markets and in Washington, and specifically how all this impacts you. The majority of our employees continue to work from home and practice social distancing. Our risk committee and leadership team is preparing a tiered approach back to work for HORAN. And as we can back into the office, we'll have stricter guidance on public spaces and meetings. That we're going to try to maintain as much safety as possible for our employees and our friends and clients. Until then, we'll continue to deliver the best service possible to our clients as we work from home. At HORAN, we focus on 27 fundamentals throughout the year, and this week's fundamental is practice blameless problem solving. And so the whole idea is about trying to not promote blame on anyone or individual or group, but to figure out how to work collectively to get to a solution. We identify lessons learned and then use those lessons to improve ourselves and our processes so as not to make the mistake again. HORAN is, of course, just like you, so grateful for our first responders and medical professionals, heroes in all the regions that we serve and around the country. And we now put a banner on the front of the building in Blue Ash, in Kenwood, Blue Ash, to honor them. And so I hope you guys all get to see that. It might be on the screen there, yeah. Over the past 6 weeks, we've been fielding cell calls from many of you unsure about what actions to take or not to take. And you are certainly welcome to email in those questions anytime you wish. But today we're going to talk about economic outlook and reactions from Washington. Let me introduce the panelists today. We have Paul Carl with 33 years of industry experience, 8 of which are in the Department of Labor. His fiduciary expertise helps us serve a large variety of businesses in designing their retirement benefit programs. We have Michael Hermes, a CFA, helping clients in crafting holistic financial plans. And his main area of expertise is investment management. David Templeton, another CFA and the managing principal of HORAN Capital Advisors, has 30 years of experience in the financial services industry. And by the way, an avid reader of all financial data, good and bad. Greg Hornschmeyer, who's been in the life insurance business and helps individuals and businesses design insurance portfolios for life insurance, disability, and long-term care. Finally, Matt Antonucci, a CFA, responsible for the investment and planning needs of HORAN Capital Advisors clientele. And so we're going to start with Matt. He's got a great slide here that talks about how the market has increased significantly over the 6 weeks that we've been on the air. We're not taking total credit, but we're going to grab some of it. Matthew?
We'll take partial credit, Terry.
Right.
So to kick things off, we just wanted to address a question that we get often given the market run from the low that we've experienced. And one of the things that we're hearing from clients often is can we trust this rally, or are we in for another downdraft in stocks? And as we've said on previous webinars, we think that the market could potentially be trading sideways for a period of time before we get better news. Ultimately, time will tell. But historically speaking, strength in the market of the magnitude that we've experienced has been a positive long-term sign, and strength tends to lead to further strength, or at least historically it has. So on slide 5, we're showing you what we mean here. So this is a look at the best 20 days for the S&P 500 and the subsequent returns, looking at 1, 3, 6, and 12 months in the columns across the top of the table. And you can see the rally that we've just experienced has been the second best 20-day gain in history, just below April of 2009. And the market results going forward from a big 20-day rally are pretty interesting. So near term, after we've had a big gain in the market, so looking at 1 to 3 months, the market is positive about half the time. And we're showing you this at the bottom of the table. And the gains are slightly positive. But as we look out farther, 6 to 12 months, the market's been positive in nearly all periods, with an average gain 6 months out of 9.6% and just shy of 21% as we look out a year. So strength in the market of this type we just experienced has historically led to muted returns near term, but positive longer term results, which coincides with our theme last week, which is that the market is forward looking and will likely begin to price in positive developments before this happens. So we also want to highlight some action that we saw in the commodity markets this week, and that's the dramatic swings that we saw in oil. It's been well publicized that the May futures contract for oil went negative, dipped into negative territory this week, and David's going to touch on that and what drove the drop.
So Matt, real quick before we do that,
Sure.
you shared a slide with the group the other day about cash on the sidelines. Could that be some of what's driving the strong advance and what drives it in the longer term, say 6 or 12 months? I forget what that number was.
Absolutely. So what David's referring to, I shared internally here, there's the amount of money in money market funds right now is it's at an all-time high. And that tends to be a contrarian indicator. So when everyone's sitting on cash on the sidelines, that means there's money to be put into the market. And it can be a sign that once things get moving in the right direction, there's a lot of money that needs to come into the market, and that absolutely could be some of what's driving results near term, just people being underexposed to stocks and needing to get back in.
And that was like 4.6 trillion, right?
It was, yes.
Is that the number?
Yeah, it was big. So on the,
I have another question for you guys before you go there, because I noticed that the biggest change was the 2009 change, where we had 23% after 20 days. And yet, 2020 and 2009 look very different, do they not? I mean, if you look at investor savings in 2020 versus 2009, if you look at banking strength 2009 versus 2020, I mean, we really have a very different economy in 2020 that we had in 2009. Would that not be the case?
We do. We think that's absolutely a fair statement to make and a good point to make. You know, coming out of 2009, we were in a much different economic environment, and kind of the silver lining for the drop that we've experienced this year is that we've come off of a somewhat stable situation economically.
now, but the one difference would be economic activity has pretty much collapsed here because everybody's sitting at home because of the quarantine.
Yes.
Not only in the U.S., but globally. I mean, there was still economic activity taking place back in the 08, 09
I
period.
think that's a very good differential, and so it's possible this will have a longer tail to it.
Potentially.
Potentially.
Yep, potentially. So on this slide that we see on the screen at the moment here, this has to do with the energy markets. And the news recently was the fact, earlier this week, energy prices collapsed. A barrel of oil, they were paying you $37 a barrel of oil if you would just take it off a producer's hands. Now, this was in the futures market, but it is a sign of the overproduction that's taking place. And some of that we talked about on some earlier webinars about the Saudi Arabia and Russia issue. But as you can see on the right-hand side, the right-hand chart, the other contributing factor here is the fact that the demand for oil has collapsed significantly. On the right-hand chart there, that blue line, the daily demand barrels per day is 13.8 million barrels currently. The average is about 20 million barrels per day. So we've had this huge collapse in oil. The other issue at play on the left-hand side of the chart is the inventory in oil continues to grow. It's 519 million barrels. Storage capacity, 653 million barrels. Well, we currently have a disparity between production and demand of about 6 million barrels per day. So in about 3 to 4 weeks, storage capacity will be all used up. So that's the issue, is we're overproducing with oil. And so they say the solution to this is lower oil prices fix the supply solution, because we'll start seeing oil production get shut off, and we are starting to see some of that now.
David, it's expensive to bring those oil platforms back on track, are they not?
It is, and they don't like to turn them off because then they'll wait. But we do need to get supply down, and having some of those shut down would be a huge benefit in getting some of the supply turned down.
You know, I was reading this week, one of the interesting stats I saw was how what small percentage of oil is used up in airplanes. Sometimes think that airplanes are going to solve the problem if we get it back in the air, but it's only about 7% of total oil consumption. Is that correct?
Right. I think that's the number. The other thing that's at play here, Russia and Saudi Arabia in March, they could not come to an agreement, and Saudi Arabia turned up production by 12 million barrels. Well, they've agreed in the new agreement here recently to cut it by 10. Well, they're still overproducing, so we're likely to continue to see some lower oil prices here.
So if you've got any couple of oil barges hanging around, someone could use them at this point.
or drain your swimming pool with oil. Might be worth something in a year.
Well, this is, reverses the old saw, pour oil on troubled waters, isn't it?
Yeah, right, exactly, exactly. I think Michael Hermes is going to touch on something else with respect to performance.
Michael?
Yeah, great. Thank you very much. So really being a financial advisor, there's two main questions that I tend to get from my clients, and we'll touch on both of these. The first one is, should I sell out of my investments or switch the way that they're currently invested? And so one quote I always like to tell my clients during times like these is by the famous value investor, Warren Buffett. And he stated, "Be greedy when others are fearful." So historically, this has always been a good investment mantra to have. From experience, we know the best time to stick to your investment discipline and buy is usually when you feel scared, but there's a strong likelihood of favorable medium to long-term outcome in the economy, which we tend to believe is true today. So it's kind of that whole buy low, sell high, not the other way around, correct? And so this chart that you're viewing right now shows previous occurrences of bear markets where stocks fell at least 25%. And so it kind of goes on to what Matt was saying earlier. And we can see from the chart, when this occurs, there's a favorable chance that over any 1, 3, 5, and 10-year time period, there are strong stock market returns. And so our advice typically to our clients is to wait out this decline, and the market should hopefully recover like it has always done in history. Now's not the time to get fancy and try and market time with your portfolio. And so the market rewards patience. So stick to your disciplined investment strategy, and you should be rewarded. So that's what I wanted to talk about with in regards to the investments and the questions I've been getting from an investment standpoint. One of the big, as you know, the legislation with the stimulus checks, question I've been getting is, what should I do with that stimulus money that I've received? And so first and foremost, you want to keep in mind that the money was sent to you because the government was worried about individuals not being able to meet their most basic living expenses. So think of your mortgage and your utilities. Therefore, the money should be saved and used to fund any of these expenses should a shortfall of money occur in your household. If you're fortunate enough to have enough cash saved up on the sideline equal to 3 to 6 months of your living expenses sitting in a savings account, then you do have a lot more options as to what you should do with that money. So first, we encourage people to use that money to build up their emergency fund if they did have to start dipping into it. If you do have an adequate emergency fund saved up, you should then use that money to pay off any high interest rate debt, such as your credit cards or student loans. If you're fortunate enough to have no debt and an emergency fund, then you should start looking into tax sheltering that money. So first, if you have a health savings account with your employer, you could look at contributing that money into your HSA to save for any future medical expenses you might occur, so that you can use that money tax-free and that it will grow tax-free as well. If you're already maxing out your health savings account or you don't have access to one, you can contribute that money into an individual retirement account and invest that money that way instead. Also, while you're doing that, it's good to use this time to make sure you're contributing at least the amount in your employer plan that maximizes any employer match you might be eligible for. Lastly, if you've done all of this, we would encourage you to look into using that money for other financial matters, such as making sure you have adequate life or long-term care insurance and making sure that your estate planning is buttoned up. So hopefully you've all found this insightful. And if you have any questions in regards to this, please reach out to your trusted advisor.
Thank you, Michael. That's great. Appreciate that very much. Paul, are you on to give us the Washington update?
I am prepared to give the Washington update.
It's lengthy this week.
It is. Three separate slides, so try to go through them as quickly as possible. So I'm going to start out with unemployment figures. Going to bring a little sober reality to the conversation this week. We had 4.4 million seek unemployment benefits last week, which is bringing total jobs lost so far in a 5-week period to 26.5 million. For comparison purposes, between 2007, December of 2007 through 2009, job losses approximated 11.1 million. So we're more than double only 5 weeks into this. The interesting part is coming out of that 2007, 2009, it took 76 months to recover those jobs. I'm looking at David. I don't know that we're anticipating that lengthy of a recovery this time based on what we know right now. Is that an accurate statement?
Right. We would hope that once the economy gets back up and running, there's going to be a V-shaped recovery in some industries like restaurants and retail, that they're going to hire
Airplanes.
Airplanes. Well, airplanes might be a slow recovery, but right, we're hoping it'll be a little bit quicker than this last time. Yeah.
Well, what's data that you've seen? Have you seen anything with those 26.5 million jobs that are lost? How many of those are permanently lost? I know you mentioned restaurants, Dave, are coming back, but how many of these restaurants, and it's hard to say, probably won't come back?
Yeah, I was going to say, what I've seen so far, Greg, on that point is really more speculation. I don't want to be into the speculation part, you know?
Sure.
I mean, because we don't know.
Well, we talked to an
unprecedented.
attorney just recently that works in that industry, and he speculated it could be 25 or 30% of restaurants don't reopen.
Wow.
Yeah. So
That's not HORAN's numbers, that's an attorney's number, right?
That's an attorney's number.
that's,
We have compliance here.
there you go. And I just on a local front, I attended a Chamber of Commerce meeting virtually this week, and they had a presentation from the NKU Center for Economic Analysis and Development. And through April 17th, the Cincinnati metro area has seen 171,200 filed claims. And for Ohio and Kentucky combined through April 17th, it was 1.25 million. So,
Wow. Paul, if someone wants those slides, and they're very interesting, they can email Jody or our website, and we'll get them to you.
absolutely.
Okay.
Absolutely. So to talk about coronavirus relief, last week we said, fingers crossed, we're going to get a new package by the time we present this week, and we said it's going to be somewhere between 250 and 500 billion. Well, lo and behold, the Senate passed it on Tuesday, the House passed it Thursday, and President Trump signed it earlier today. We have 484 billion in new funds for coronavirus relief. 370 billion of that is targeted for small businesses as part of that Paycheck Protection Program. Hospitals are going to receive 75 billion, and there's 25 billion for testing, all items related to testing. So that's some good news that we've got, you know, some additional funds coming, especially for small businesses that missed out the first time. This does bring the total to 2.7 trillion of specific relief in the past 6 weeks. And just to give you an idea, again, comparison-wise, 2008, 2009, that relief approximated about 900 billion. So we definitely learned some lessons, I think, the last time, that it's better to be more generous and keep the economy stimulated. The other interesting part is with Congress returning in May, we're looking at potentially another $3 trillion in additional. So we'll see.
A T.
Hey, yeah, a T. We'll see what happens. And then last part for me is with regard to the Fed stimulus. The Fed's been authorized to purchase up to $16 trillion of outstanding debt. Current projections are right now that it'll peak at about $9 trillion in June. To give you an idea, 2008, 2009, this equivalency translated to about $4 trillion. And ultimately, what we're doing here is just helping keep interest rates low and cash in the system.
During the Depression, I think they called these type of programs priming the pump. Now we're taking a fire hose and shoving it down the pump, it seems.
Yeah, we are.
Yeah.
We are, so.
Greg, you, in response to questions you had, you're putting out a piece this week on life insurance, were you not?
I did. We have a piece out talking about, there's a lot of interest in life settlements. So if you have an old life insurance policy, typically companies are looking for someone probably over age 65, but if you have a life insurance policy, think of that as an asset, not necessarily an expense. And there's companies being very aggressive at looking at current life insurance policies. It could be a term policy, it could be a permanent whole life, variable, universal life policy. These companies will be, if you have questions on that, reach out to us. Be happy to take a look at that and answer any questions, because it is an opportunity if you're looking for cash and don't leave the life insurance in your portfolio. It's an opportunity to perhaps even up some cash that you lost in the market.
Yeah, so these organizations are actually purchasing the life insurance from you.
Correct.
Right.
Correct. That's exactly right.
That's great.
Hey, Terry, we had a question,
Yeah, sure.
come in, and people on the panel here can help me, but the question was, how does this negative impact that small businesses are feeling with being shut down? How is that impacting them relative to larger companies that might be that are in the S&P 500, let's say, public companies? I don't know if anyone wants to stab at that, or.
Well, I think you'd be the expert on that, David, but it seems to me that from an investor point of view, you have a bias towards the small, better financed companies as opposed to the smaller companies at this point who may not have the same access to debt, may not have the same access to a cash balance that a large company does.
Right, so
They're biased.
the large company, exactly, I would agree with that. Larger companies going to be less impacted likely because of the slowdown. I mean, small companies aren't impacted by the stock market necessarily, and some of these large companies can, maybe pick up market share. I think the risk would be smaller companies going out of business, fewer people employed, the consumer 70% of the economy, so fewer consumers out there here in the, whatever the time frame would be, a year or 2 years, that could damage at least the growth rates or hinder the growth rates for larger companies, I would think also.
Yeah. One area we haven't talked about, David, that's interesting in the large company space is the retailers. There's been all sorts of news that would say we're not going to see a retail market as robust as what it's been in the past. Would that be fair?
Right, and we talked about this on our blog from time to time about the U.S. is much more over retail than the rest of the world, and this probably, it would not be a surprise to us that this environment is used for some retailers that are just not going to reopen.
Well, Neiman Marcus, they follow, right?
Yeah.
I mean, Penny's is now talking about bankruptcy, and so this is probably going to take out a lot of retail space, and that's going to change the whole investment landscape, be it real estate investment trusts or REITs that are focused on shopping malls and shopping centers and strip centers, and that's not the only space that's going to see change from an investment perspective going forward.
There's also going to be a wealth roundtable this week on qualified plans. Am I correct on that, Paul? There's a qualified plan roundtable for our employers.
We've got something in the works. I don't know if it's going to be this week or next week, Terry, but we'll have something. But yeah, it'll be more of a podcast.
Podcast, got it.
Yep.
Thank you. So look for that on our website, please. Any other questions from comments from anyone else? Well, the last slide I think we want to put up is something very beautiful. A few years ago, in response to a request from Alex Hara, who is a banker in Dayton, HORAN participated in Operation 1,000 Cherry Trees. Oh, it was 2011, my goodness. I can't believe it's that long ago. My back still hurts from putting in these trees. But we put about 10 to 15 trees at our friends and clients at Dayton Art Institute. And this spring they have been in bloom and they look absolutely beautiful. So we're showing you a picture the Dayton Art Institute sent to us to show off the cherry trees. I think spring has tried awfully hard to give us beautiful trees this spring, and we do need them. So thank you to the Dayton Art Institute, all our friends there for giving us this. With that, I think we'll see you next Friday at 2 o'clock. Look on our website for information regarding COVID-19 and what it means to you. And second, and look for our pending other webinars and podcasts. Thank you.